No. Okay.
All done.
Uh,
All done, sir.
first,
All
uh,
done.
uh, first we will recall what we have done yesterday. There were few concepts which we learned, and that is very much important. One is the active and passive income. We as a teacher and even the banker like Dr. Manoj, we used to file our income tax return. And the question is how to identify the list of active and passive income. So I will just you brief how to identify the active and passive income. Then one most important concept was how to calculate an effective rate means the frequency. Frequency plays a lot of role in your the effective rate. If someone is paying you interest monthly, quarterly, or daily basis, it is going to make a lot of changes in your corpus. Then we have discussed power of compounding. Then we will discuss. Please unmute the new participants who join. Then we will discuss what is the difference between financial planner and the product expert. Let first start with the active and passive income. We all are the teachers and or banker. So we know income tax department itself says in income tax, we teach the paper income tax planning in tax procedure. And what are the sources of income for an individual? Sources of income for an individual, for an individual. Just go through it. Just go through it. The first source is income from salary, income from salary. Then the second source is income from house property, that is rental income. And the third one is income from capital gain, capital gain, capital gain. And then fourth one is income from business and profession, business and profession. We need not to go anywhere, business and profession. And the fifth one is income from other sources, other sources. Our income tax department says there are 5 sources of income for an individual. And when we sum all these, we get, this is known as gross total income, gross total income. And with this, we use deductions and we get the total income. And now see, income from salary. This is your active income. This is your active income. And all these are your passive income. All these your is passive income. Passive income. You need not to go anywhere. You just see. Even your income tax department suggests you as an individual from where you can earn money. If you are not exploring all these sources, the problem is with you. Please remember, when you will observe all the rich people in India, all the wealthy persons, celebrities, you will found that they are paying crores of tax. Why? Because their gross total income is very high. And with this gross total income, you get total income, and then with this total income you calculate tax liability. Our focus is just to minimize our tax liability, and therefore we restrict ourselves up to the salary only. Active income is only. We are teachers. Every day we teach the tax planning, tax procedure to the student, but we are not applying those concepts on ourselves. Is it the income tax? But the whole total income is not going to the tax department. A part of that is going to the tax department. Our celebrities, our businessmen, our corporates, they are exploring all these passive incomes. That's why their total income is in crores of rupees. That's why they pay crores of taxes. So you need not to go anywhere. Just look at the income tax department. All these are being salary, it is the active income, rest are your passive income. House property means rental income. So now after today onward, you should explore one by one. You must have all these passive incomes in your portfolio to attain the financial freedom in your life. Means you have some rental income, you have capital gain. Capital gain means it could be financial asset, it could be the physical asset, and it could be the shares, debentures, whatsoever is. By selling those as financial asset, you can have a capital gain. By having the physical asset or tangible asset, you selling those, you can have capital gain. If you're not doing, it is your problem. Then you are being a management professor, you are a professional person. So if you are not exploring, if you are not earning through your business and profession in a side by side, then it's your problem. Other sources means you must have sources for dividend, interest. There are lots of sources. All these are the passive income. So please make sure, just because of saving tax, you are restricted, you are minimizing your total income. So and the people take it, say very proudly, okay, we are paying nil tax, we have saved all the taxes. Means your total income is very low. And why it is very low? Because we are restricted to only one source of income, that is salary, that is the active income. Had you been explored all other sources, that is the, to be aggressive in your life, diversify your portfolio, one by one, not suddenly, but one by one, explore all your passive income. And it is the income tax department that guides you what, as an individual, you can explore. All these sources are all there, and this is permissible by law. There is no illegality in that. As an individual doing the job, fine, you are getting the salary. But side by side, you should earn through the rental income, the capital gain, the business and profession, and other sources. So my point is, you need not to explore what are the sources of passive income. Just see, as an individual, your income tax side. This is what active and passive income. So please try to maximize your passive income, because sooner you will explore all the passive income, you will attain your financial freedom. Don't dependent on your active income. Financial freedom is there. Because when your passive income will cover your household expenses, you are financially free. Then second concept I told you, effective rate. Effective rate is very much important, because it affects you a lot. I gave you the calculation for the effective rate. I'm just showing one. This is the Excel. Are you getting the Excel sheet? See, suppose yesterday we have done the effective rate. If you are paying the monthly, then what will be your, suppose, what will be your monthly return? This is the effective rate. And if the frequency, if the interest is created monthly, your effective rate will be more, though the annual rate is for 12%. If the interest is credited quarterly, your effective rate will be different. If it is credited on daily basis, for example, bank on deposits now paying the interest on daily basis. So that accumulates on daily basis. So the frequency is very much. So when any financial advisor, like insurance advisor or a mutual fund advisor, any product experts come to you, just look at the figure. Whatever is the annual interest rate, what is the frequency of that payment? Is it paid monthly, quarterly, or daily basis? Because this will the effect. This will make a lot of difference. See, suppose Mali, uh, you are paying monthly. Then what will happen? This is there will be 12 period, and you can calculate it. Anyone can tell, if it is paid daily basis, then what will be the, uh, if it is 100, then what will be the interest? Interest is, of course, equal to 12%. 12% divided by 12, that is 0.01. And your closing balance at the end of first term, means first month, becomes this multiplied by 1 plus this one. right? Then you drag it to the 12, and then you will find in the next equal to, equal to, and then you will find see, here you are getting at last 112 rupees 68 rupees, because the interest payment is done on quarterly basis. Interest payment is done on quarterly basis.
Sir, it is on quarterly or monthly basis, sir?
It is on monthly basis. Sorry.
So, sir, can we say that 0.68% more
You
we
get
are receiving?
extra. Yes, yes, you are getting more. And suppose if the same, because 12% is the annual rate, they are offering 12%, but the frequency of payment is monthly basis. That is why this change is there. And suppose it is on daily basis, see what will be the change. On daily basis means what is the interest is equal to 12% divided by what? 360, 365. Make it 365. This is the interest. Term is how much? 1, then 2, then 2. See the difference. See the difference. And opening balance is 100, suppose. Then what will be the closing balance? This into 1 plus this. This is your first month. And in the second month, you start this figure, and now simply drag it. Simply drag it. How many? 365. There is something wrong, because on daily basis it should be more than that.
Yes, sir. In
Mm,
fact, it is less than the monthly basis.
just I am checking it, because the interest is different. Equal to 12%, 12 um, divided by 365. This is 12 divided by 365. Then this is equal to 100 multiplied by 1 plus this one, 100.3 into this equal to
But it works to 127.47.
This is 120.
7.47.
So why not it is working? I will check it out because it should be more than the monthly. Because
Certainly.
daily, I will check it out. Don't waste time. But remember it. My point is, when someone offers you any annual rate, just look at the figure whether the payment, interest payment is created on monthly basis or quarterly basis or the daily basis. When the frequency is more, the effective rate will be obviously more. So look for that. There is some calculation. I am missing something. So I'm not wasting the time. So we will look at that. This is what effective rate is all about. In effective rate, you have to look the frequency. What is the frequency for interest payment? Frequency for interest payment. Frequency for interest. Because this will make a significant, when the amount is very huge, this will affect your decision making. Then we have already discussed the power of compounding, and it is well known because n is at the power stage, and in the power you have already seen that power of compounding. You have already seen the magic of compounding. There are three person, and you have seen Mr. A has invested only 7 lakh rupees and left the money. He took the pain at early age, and then he rest of the life, and he earned crores of corpus at the end of life. You have yesterday calculated. We have all these, so I'm not going into that. So this is also very much important, and the logic behind this is because in our calculation, the n is at in the power mode. The n is in the power mode, the time period. So when you give more time, because in these three variables, saving, rate, and n, because in today's scenario, it is very difficult to save more. And through smart investing, you can increase the R, value of R. But N is very much important. If you give more time, obviously you will enjoy, reap the benefit of the compounding of magic of compounding. So we have done all these. I'm just recalling what we have done yesterday. Then we are going to the most important thing, that is, then there is a question, what is the difference between financial planner and uh, product expert? Uh, Look, a financial planner is like personal financial doctors, personal financial doctor. This is the US concept. In US, what happens? Doctors diagnose the problem and make the prescription. This much of salt is given, this potency to cure this problem. And it is the job of the druggist or pharmacist to offer the product. Same with the financial planning. Financial planner, because each individual has its own income level, saving level, each individual has its own risk appetite. In personal financial planning, what happens? First, you will assess the risk assessment. And risk assessment of an individual is very much important because you don't know whether you are risk averse. There is a scientific mechanism to calculate whether you are risk averse or risk taker. Means you are aggressive or conservative. Accordingly, a financial planner makes a plan for you. To miss, suppose there is a financial goal, he calculates the corpus for financial goal, corpus for short-term, mid-term, long-term financial goals, like education of children, marriage of children, construction of financial goals. In the first step, he does the risk assessment. In the second step, the financial planner calculates the corpus for the financial goal. Then in the third step, he suggests uh, this is the X amount. In the third step, financial planner suggests you should invest X amount at the rate of R%, then you will achieve that corpus. Now, after the financial planner has done its role, then the picture of product experts come into the place. Product expert means, suppose you are taking mutual fund, the mutual fund advisor is the product expert. If you are taking the insurance product, the insurance advisor is the if you are involved in the shares, then share broker is the product expert. So there are different experts for the different financial products. So once the financial planner has done the risk assessment, has calculated the corpus for the financial goal, and based on your risk appetite, uh, and he calculated the and after calculating the financial goal, he will suggest you invest X amount at the rate of this. This rate is based on the risk assessment, how much risk you can afford. And then he will say, if you will invest this amount at the rate of this for this time period. So look, X amount, X amount, X amount at the rate of R% for time period T, for time period T, and then you will get your financial corpus, your corpus to achieve your financial goal. So it is the concept of US. In US, it is the financial planner who makes the planning. He calculates the your how much corpus is required to achieve your financial goal, like education, marriage, construction of house, and all that. And then he suggests is this how much amount you need to invest based on the risk appetite. He suggests how much return you can expect. Uh, and then for which time period you should remain invested, and then you will achieve the corpus. Now, after this, the role of product experts comes. Then after the role of financial planner, the product experts comes into the picture. Now, if some insurance advisor or before financial planner in US, no financial product expert can approach you, because once the financial planner has done the financial planning, then the product experts comes, and then you may say, okay, see, this is our financial plan. If you have any product suited for this plan, then you can sell me. So financial product expert will offer you the product in line with your planning. But in India, what happens? All the product experts are the planner itself. Either it is the insurance advisor or mutual fund advisor or stockbroker. They do like the same way. Before the doctor gives you the prescription, you directly go to the medical store, and medical store the person in the pharmacist or medical store person will guide you what medicine you are supposed to take. So this is the reverse situation. So this financial planning concept is the US concept, and this is the one of the robust concept, because once the financial planning is done, then the role of product experts comes into the picture. And now most of the bankings have started customized financial planning for their customers. Earlier, these facilities were available to the HNIs only. Now, the good banks are offering this for their retail customers also. Retail customer means having the bank deposit of 5 lakh, 10 lakh, etc. And they are offering the services of the financial planning. Once the financial planning is done, the same bank or other advisor will approach you and will offer the product suited for your as per your financial plan. So I hope you have understood this. Okay, what is the financial planning? And now the today's session, that is the most important session. That is what is the innovative products which we are going. In today's session, we are going to discuss what could be the innovative products which over the conventional products for smart investing. This is our topic also, is smart financial planning, personal financial planning with smart investing. Now, uh, you people have a basic idea about the those who are from the finance background a little bit know this, but a conceptual clarity is very much important, which I am going to explain when it comes to see the conventional products. First, see the conventional product, conventional investment products. Conventional investment products. Conventional investment product. What could be those products? Let's say one by one. You will say bank FD, bank FD. Then you will say mutual fund. Then you will say shares. Then you will say property. Then you will say gold. Then you will say post office RD. Then you will say any other products, commodities, right?
Real estate, sir.
I've covered this, property or real estate.
Okay, sir.
Anything left? When we talk about the investment product, we normally look at these things. Bank FD, yeah, bank deposits, FD or deposits.
Sir, corporate FDs, sir?
Corporate FD. That is the same class.
Right.
FD means FD. And then you have mutual fund product. There is a huge range of mutual fund products, mutual fund schemes rather. And then you have a huge market for the shares. Then at max, you can go for the derivative products. Out of these things, conventional products, I'm taking one by one and I'm trying to convert the substitute of the most innovative product. How will you substitute these conventional products into the most innovative products, which will give you a reasonable, handsome amount of return? First, I am taking the gold. This is very close to everyone. Gold. Can you tell me what are the basic features of gold? Anyone? First of all, what are the? This is the one of the 24-hour market. When we say 24-hour market, means gold is traded throughout the day and night. 24-hour market. There is no stoppage in the gold. Trading of gold is done 24 hours. Our stock market starts in the morning and closes in the evening, but gold market runs throughout the day and night. Number two, gold is inversely accepted metal. Inversely accepted metal. Means if you have gold, you go to any country and it will give you the purchasing power. If you don't have foreign currency, if you don't have local currency, just surrender the gold, have a transaction, purchase any of the resources. Just this is the inversely accepted metal. And third, it cannot be speculated. Please remember, it cannot be speculated. It cannot be speculated. You can speculate anything in the world except gold. Even if you are 1,000 people, 1 lakh people, 1 crore people just come together, put the money and try to speculate the gold market, you cannot. Because this is a huge amount. The fourth feature of gold, it cannot be produced overnight. It cannot be produced overnight. Means there is a scientific process, there is a process, and it will take time. Processing will take time. If you want that produce the gold as much as possible, this is not the factory material. Okay, you just have a production 2 to 3 factories to produce the gold. Like car, you can produce overnight, but it cannot be produced overnight. Means you cannot increase the production of gold as much as you can. uh, it is produced through a scientific process, and that will take time. So these are the features of the gold. And the most important feature of the gold is why this is close to me, because this is the inflation proof material. Inflation proof metal. Can you explain what it means, inflation proof material? Means this gold protects your purchasing power. Protects your purchasing power. Purchasing power. This is the only thing in the world which protects your purchasing power. Your purchasing power will never get done. It is the inflation proof metal. Inflation का इस पे कोई impact नहीं होता. There is no impact of inflation on the gold. It is the inflation proof, and it has been proved worldwide that gold is the inflation proof metal. Now I'm explaining this concept through an example. Professor Manoj, Dr. Manoj, sir, can you recall what was the price of 10-gram gold in your when you were young, when you have started your career?
Sir, I can guess only it may be some say 2,500 or 3,000 rupees.
Yes, 3,000 rupees. And which year it could be there?
So it may be, sir, somewhere in 83, 84.
1983, right? 84. You are 100% correct. Now, what is the price of 10-gram gold in today? As of now,
63,000.
63,000 rupees in 2024. Sir, let me tell, just explain me. In 83, with the help of 10-gram gold, whatever food grains like wheat, rice, whatever is food items is there, whatever food items you can purchase with the 10-gram gold, that amounts to rupees 3,000. Because at that time, nowadays with 10-gram gold, you can purchase the same items nowadays. If you have 10-gram gold on that, whatever purchasing power with this, whatever food materials you can purchase, food materials. Now with that 63,000, you can purchase the same amount of food material. Is it true or not?
Yes, sir. Very true.
Because that's why it is said, and it is proved worldwide, that gold is the inflation. If you have 10-gram gold at that in 1983-84, it cost rupees 3,000, and whatever food materials you can purchase with rupees 3,000 in 83-84, now you can purchase the same food with 63,000, because the price has gone. That is why it is said in your portfolio gold must be there, because it is the only inflation proof item. This is the example how you can see Okay, gold is the inflation-proof metal. It protects your purchasing power. Whatever is situation, whatever adversity is there, your purchasing power remains protected if you have gold in your portfolio. Point is clear?
Yes, sir.
Now I'm coming to this thing, but uh, uh, very important thing. Now, how to invest in gold? Now I'm coming to the product, how to go for the gold. If gold, in gold, if you go for the physical gold, physical gold could be in the form of jewelry, or bar, anything. But it has lots of demerit. Demerit number one, when you approach to the goldsmith during the selling, he will make some cut. During the sale. During sale. Second problem is safety and security. Safety and security. So having physical gold has two issues, major issues with you. When you will go for selling of the goldsmith will make some cut. And whatever logic he will give same argument, and he will justify that he will not give you 100% amount, will make some cut, definitely will make some. And ultimately you will agree. And then the second issue is safety and security, because how will you make it safe and secure? The second option for the gold is the gold fund. Gold fund. Now, gold fund is one of the mutual fund scheme. Mutual fund scheme. Now, let me clear about what is the difference between shares, because here in participants, there are two categories. So one are the students and second are the professionals. Shares and mutual funds. Investing in shares means what? You are investing in assets, direct investment in asset. You are directly investing in assets. Investing in assets. Because you become the shareholder. You become the shareholder and you are entitled for dividend during the holding. And when you sell it, you will get your capital gain. Now come to mutual fund. Mutual fund investment is done through the mutual fund schemes. Mutual fund schemes. Right? When you invest in the mutual fund scheme, see the concept of mutual fund scheme. What is the problem with the shares? There are three categories of problem with the shares. First, you lack professional expertise. Professional expertise. Second, you lack time because you are in the job. Third, you have a limited amount of money. So there are three problems with the shares. Limited amount of money. As you know, diversification reduces the risk. And you cannot purchase because you have a limited amount of money. Therefore, you cannot purchase more and more shares from different companies. Suppose Infosys, Vale, and then Reliance Industries Limited. There are so many shares. They are costly shares. So you cannot purchase as much as you can do because you cannot diversify after a certain limit because of limited amount of money. Secondly, being full-time job, you are in the full-time job, so you lack the time also. And second, you lack professional expertise also. You don't have infrastructure, you don't have knowledge about that. Then what is the solution for this? You just hire some expert, and that expert is known as fund manager. and hand over the money to the fund manager. So in what is the functioning of mutual funds? It is the fund manager, that is also known as AMC, and all the investors pool the money to the fund manager, and we call them investors, and this is known as unit holders, because in mutual fund units are sold, unit holders. And then this fund manager invests that money into the market, like company 1, company 2, company 3, and makes a portfolio. Portfolio means set of investments. Portfolio means set of investments. Set of investment. Now, what happens? You are simply you are giving your money to an expert. Now, all the problem is solved, because there are lots of investors who are poor. Now he is the market expert. Second, he is the full-time job. He has the full-time job. There is no constant for the time also. Then he has a pool of fund, and this pool of fund is known as asset management company. And if you will see the mutual fund organization, this pool of fund is known as asset under management. Asset under management. Asset under. If you will see the mutual fund data, you will find, for example, Reliance Mutual Fund has 8,000 crore rupees for one scheme, and it is a big amount. Now there is no limitation for the fund manager to diversification. For the diversification, he can diversify as much as possible. So when you hand over your money to the expert, that is the fund manager, all the problem, all the limitations of directly investing in shares has gone. But and this fund manager is for each and every. So there is a mutual fund organization, and this mutual fund organization launches mutual fund schemes. Mutual fund schemes. Mutual fund schemes. And this mutual fund schemes is managed by the fund manager. For each mutual fund scheme, there is a separate fund manager, and this fund manager take the position into the market. Now, what is the difference between share and mutual fund scheme? Investing in mutual, you are investing in the concept, story. Your fund manager says, your AMC says this mutual fund scheme has this investment objective. We will diversify your fund in different companies share. We assure you guaranteed return or some amount of return depending upon the investment objective. So you are investing in the concept, because here in shares you are directly investing into the asset. But when you invest in mutual fund scheme, you are investing into the concept. Money is invested in the market by the fund manager, not you. You are the investor. You are not directly approaching to the market. You are approaching to the market via the fund manager. So I think this is clear. And now here the question of the schemes come. What are the different categories of mutual fund scheme? From that, we will explore the innovative products which you should know, and that is the mutual fund schemes. Because investment is done mutual fund schemes, and there are different mutual fund organizations: SBI mutual fund, ICICI mutual fund, HDFC mutual fund. All these mutual fund organizations are legally registered as a trust. And this AMC is a private limited company, means they don't have their own shares in the market. Otherwise, they will invest in their own shares. So that is why SEBI has made a lots of restriction. That is why investment in mutual fund is the one of the safest. Second, what are the different mutual fund schemes? In 1996, the then Finance Minister P. Chidambara has made it mandatory for all the mutual fund scheme that all the fund managers that they should disclose their investment objective in the name of scheme itself. Name of scheme must carry the objective of scheme, broad objective of scheme. Now, based on this, when we take about the equity market, we are taking only the share market. So based on this, there is a scheme like equity diversified mutual fund scheme. Now, after this, I will tell you how to screen the real mutual fund schemes, which is best for you, where how to analyze the mutual fund scheme, how to choose a particular mutual fund scheme. Because as I told you, shares is not a cup of tea unless you have professional expertise, unless you have a sufficient time, and unless you have a sufficient amount of money. Therefore, mutual fund is one of the safest, but you should know what are the mutual fund schemes that are innovative and which you should explore rather than the conventional mutual fund schemes. Now, one is the equity diversified mutual fund scheme. Diversified mutual fund schemes. And there are lots of equity diversity. I'm just after this, I will just take you how to screen the best performing equity diversified mutual fund schemes. Then there is a sectoral mutual fund schemes. Now, here the fund manager is bound to invest your money in a particular companies of a particular sector only. I'm giving you the example like power fund, gold fund, gold fund, IT fund. As the name says, and it is done in 1996. Before 1996, scheme with the it was highly confidential. Fund managers were not able to disclose what is their investment objective. But Mr. P. Chidambaram, the then finance minister, 1996, made it mandatory for all the fund managers to inbuild a broad objective in the name itself. After that, just see the name of the scheme. Equity diversified mutual fund scheme means your fund manager will invest into the different across the sector shares of to the companies across the sector, IT sector, pharma sector, power sector, whatever sector is there. So as different sectors of economy. Now here fund manager is free to choose, can diversify across the sector. But in sectoral fund, like it is power fund, here fund manager is bound to invest your money in the shares of those companies belonging to power sector only. Companies of power sector. Company here fund manager is bound to invest in shares of companies of uh, companies involved in gold mining, or gold trading, gold related activity, gold trading. And here in IT fund means the fund manager will invest in the shares of those companies belonging to the IT sector only. So see, this is the sector. The third major category is the theme based. And for example, index fund. So these are the typical mutual fund schemes which we know, which we used to invest in, right? So suppose equity diversified mutual fund scheme, you have to invest in, and there are some debt-based means your fund manager will invest in the fixed income securities only. And I have taken the example of mutual fund schemes, equity-based mutual fund schemes. So this is the different categories of the equity-based mutual fund scheme, and it could be the debt-based fixed income securities based mutual fund schemes like government securities or debt debenture bond, and it could be the balance hybrid fund also. But I'm taking the example of the equity-based mutual fund scheme, and the first category is obviously equity diversified, then sectoral, then theme-based. Now see what is the difference. As I told you, sectoral means your fund manager will invest into the shares of the company belonging to that particular sector only. And in index fund, what your fund manager will do, your fund manager will do invest your money into the companies, index fund. And as we know, we have two major indexes. One is the Nifty. This is the index of National Stock Exchange. And Sensex. This is the index for Bombay Stock Exchange. And in index fund, your fund manager will invest in Nifty. We have 50 companies. 50 companies, obviously representing companies of their own sector. And in Sensex, we have 30 companies, representing companies of their own sector. So in index fund, your fund manager will invest in those companies which belong to, suppose it is the Nifty based index fund. If it is a Nifty based index fund, then your fund manager will invest into those shares of those companies which are listed under the Nifty, which is under the Nifty. That is only those 50 companies. And if it is Sensex-based index fund, then your fund manager will invest the shares of those companies which is under the Sensex, representing companies of different sectors that is included in the Sensex. This is what index fund is all about. Now, this is the typical categories of mutual fund scheme. So first, we will go to the how to screen as an investor, how to see the performance of the mutual. And when it comes to investment, there are again two concepts. One is the how will you invest? There is a concept people normally misunderstood. There is a SIP, there is a word STP, there is a word SWP. Try to understand. SIP means systematic investment plan. Systematic investment plan. Please remember, SIP is not a scheme. When you invest in a mutual fund, you invest in the scheme. SIP is the mode of payment. This is simply mode of payment. Mode of payment only. The people think that this is a scheme. No, the SIP is not a mutual fund scheme. This is simply mode. You can invest in a particular mutual fund scheme in a lump sum amount. Lump sum mode of payment is if lump sum, or in recurring mode. When you invest in a recurring mode means monthly, quarterly, or all that. So in SIP, we are allowed to invest in every month only. First week or second week, you have to choose the option. This is SIP. Like RD. You are investing a fixed amount every month or in a recurring mode. So please remember, SIP is not a scheme. It's the mode of payment, simply a mode of payment in recurring form, in recurring mode. Now, STP is the systematic transfer plan. Systematic transfer plan. Systematic transfer plan means, suppose you are in a equity diversified scheme. You have chosen equity diversified scheme. And now you want to switch over to the gold fund. So this is separate mutual fund scheme. This is separate mutual fund. If you want to transfer your money into the gold fund based scheme, then of course there are two ways. Either you sell all these and repurchase, purchase the gold fund, invest in the gold fund scheme. So in this process, you will incur a huge transaction cost and the exit load and all that. But using the STP, you can save all these charges. Just internally it is done. You just put the STP. Yeah, you want to transfer your whole schemes. Suppose you get older into debt fund, some debt fund. Debt fund means fixed income mutual fund schemes. So you can use the option of STP. Through the STP, you can change your investment in a particular mutual fund scheme in another category of mutual fund scheme just using this option. SWP. SWP means systematic withdrawal plan. Systematic withdrawal plan. Systematic withdrawal plan. Withdrawal plan. Now, systematic withdrawal plan means suppose you have made a corpus. Through SIP, you have made a corpus. Suppose your age is now 60 years. Now you want to draw a fixed amount every month. Then you can use this option like pension. Like pension. So you can plan yourself. Yeah, during the working life, you start investing in a particular mutual fund scheme through SIP mode, that is recurring mode. And after at the time of retirement, you just use this option SWP and draw a fixed amount. Draw a fixed amount. A fixed amount using SWP option, systematic withdrawal plan. So all these are the options. Secondly, there is one thing also. When you invest in mutual fund scheme, it will be asked for growth option or dividend option. Dividend option. It means since the fund manager invest into the market, so whatever obviously in the companies, so whatever dividend, whatever benefit companies pays to the fund manager, and subsequently fund manager shares those dividend to the investors. So in mutual fund scheme also, in
YP
mutual
sir,
uh,
sorry to disturb you, sir. Sir, I just want to know about the sir, tax implications in the SWP plan. Like we are withdrawing a fixed amount every month from the corpus of our SIP. So, sir, what are the tax implications? Because I have heard that only up to 1 lakh rupees is tax free. Otherwise, it will come under the LTCG. So, sir, what's the reality of this, sir?
please remember uh, uh, SWP, when you use the SWP's systematic withdrawal plan, you are getting the money. If your holding period is for more than 12 months, obviously, whatever uh, uh, whatever money you are drawing means you are selling the units. Selling the unit means capital gain. Till the holding, you are getting the dividend option. Suppose you are holding the mutual fund scheme, so you can opt for the growth and you can opt for the dividend. When you get the dividend, it is the regular income. When you reinvest that dividend, you are not drawing the dividend, it is the growth option. Now, when you go for the SWP, SWP means it is possible only when the the mutual fund organization, the fund manager will sell that particular unit. Suppose you want to draw a fixed amount of rupees 25,000 every month, 25,000. So that equivalent units were sold. Selling the unit means selling the financial asset, that is the mutual fund units of mutual fund scheme, and it will come under the capital gain. First, clear. Now, if obviously your holding period for that mutual fund scheme from where you are making SWP is more than 12 months, it will come under the long-term capital gain. If it is less than 12 months, it will become under the short-term capital gain. For short-term cap, if it is short-term capital gain, it is added to your personal income as per normal addition, like income from salary, income from. If it is long-term capital gain, then you have to pay 10% or 15%. Exactly, I can't remember what is the rate. I think it is 10% around. Mr. Sanjeev is there. He can, yeah, you can Google it. But please remember, SWP means capital gain.
So
Capital.
every month, sir, we have to pay the tax on the withdrawal amount.
From the withdrawal amount, not every month, because you pay the tax when you file the ITR. You have to show all this. What were the and the company, the mutual fund organization will send you form 16A, what were your capital gain, uh, how much units you have sold, and what was the purchase, because gain will be there when you have making a profit. Your sale proceed minus purchase price is your gain, So capital gain will be there if you have purchased the units at a lesser price and sold it at a higher price. Only then gain will be there. Capital gain will be there. So obviously, it is calculated, and they will issue a form at the end of the financial year. Yeah, when you will demand, you call the customer care, and they will send you the statement, and you have to show in the income tax return capital gain. And is it long term or short term will depend upon the holding period. If it is the holding period is more than in financial asset, the holding period is lock-in period is 12 months. In physical asset, it is 3 years. So if your holding period were less than 3 months, it will be a short-term capital gain. Otherwise, it will be long. But SWP is always a capital gain, because that amount which you are withdrawing by selling the unit. Selling the unit means you are selling your financial asset. And when you sell your asset, it is the capital gain. Clear?
Yes, sir. Yes, sir.
Now I am taking you to the how to screen a mutual fund scheme. Then I will tell you one of the most innovative product within this mutual fund universe. Because mutual fund is now inverse. And please remember, the stock market is influenced by the institutional traders. And when it comes to institutional traders, our mutual fund are the institutional traders, apart from the FIIs. So it is the FIIs and mutual fund organization that plays a big role in the manipulation, in the fluctuation, in the up and down of the stock market, not the retail investor. So understanding the mutual fund is very much required. Now I am coming to the site of money control. Just go to money control. You need not to hire anyone. Go to money control. Money control. Is it visible?
Yes, sir. It is.
Now in this money control, when you will go, there is a mutual option of mutual fund. There is the option of mutual fund. Here you can say there is the option of mutual fund, right? Are you getting commodities, mutual fund, watch list? There is the option for mutual fund. Then personal finance, start for whenever you have time just to explore this side. This is very one of the richest side. That is the money control. There is a mutual fund. Are you getting this option?
Yes, sir.
Now just have left click. Slightly move it to the left hand side, and then you will get the in the mutual fund option. When you go to mutual fund, there are two things. One is the explore, the second is the tools. Go to find fund. Find fund. Within find fund, you have mutual fund screener. Mutual fund screener. Just click on it. Mutual fund screener. Once you will do it, See, here is the fund house screener. Now you are exploring which mutual fund scheme is best for you. Now this is the fund house. So first you select the fund house. See, nowadays mutual fund industry is one of the biggest industry in India, and almost all the banks, all the financial institutions, all the brokers have launched, and all the insurance companies became the mutual fund organization, and they have launched different. See, these are the, so what you can do, just uh, remove all, deselect all. Now choose some popular mutual fund houses. Please remember, mutual fund organizations are technically trust. They are registered under Indian Trust Act, and their legal status is trust. They are not any company. Number one. Number two, mutual fund organization launches mutual fund schemes, and for each mutual fund schemes there are fund managers. One fund manager could be the fund manager for more than one scheme, but for each mutual fund scheme there is a dedicated fund manager. And as an investor, you are not going to invest in mutual fund organization. You are supposed to invest in the mutual fund scheme. So please make it clear. You are not, suppose SBI mutual fund. It doesn't mean you are investing in the SBI mutual fund. There is no investment option like SBI mutual fund. Within SBI mutual fund is the mutual fund organization, and obviously the promoter is the State Bank of India. And SBI mutual fund, the legal status, it is a trust registered under Indian Trust Act, and the promoter is the State Bank of India. There are technical structures. There are lots of entities like board of trustees and sponsors and all that. So obviously the sponsor is the SBI. Board of trustees, the SBI trustees, and this mutual fund organization has different mutual fund schemes. So you invest in a particular mutual fund scheme via SIP mode, or if you want to withdraw the money through the SW, choosing the SW option. If you want to switch from one scheme to another scheme, then you can use the STP. Within the mutual fund scheme, if you are using either SIP or lump sum purchase, then what you can choose, you can take the dividend, that's the regular income, because ultimately fund manager invest into the market, and whatever return is market give, that is given to the fund manager, and fund manager ultimately shares those dividend to the investor, that is the unit holder. uh, if you are not choosing the dividend option, normally people in mutual fund scheme do not prefer the dividend option. They prefer the growth option because their wealth accumulates. So means your dividend is reinvested in the mutual fund units, and your NAV goes. In a share market, it is the market price of the share. In mutual fund schemes, the unit price is represented through net asset value, that is the NAV. So if you want to purchase any unit of any mutual fund scheme, you have to look at the NAV. NAV means net asset value. So first of all, when you are going to screen a particular mutual fund scheme, first choose the mutual fund house. So suppose I am choosing SBI mutual fund, then DSP you can choose, then SDFC mutual fund scheme, then Franklin Templeton is a good mutual fund scheme. Mm, Where is the Franklin Templeton? Yeah, Franklin Templeton is a good mutual fund scheme. And schemes of this is a good mutual fund organization. Then you can go for the ICICI Prudential. Actually, for different mutual fund schemes, there are different organizations popular for different mutual fund schemes, particular mutual fund scheme. But suppose I am taking this 4 mutual fund organization: ICICI Prudential Mutual Fund, Franklin Templeton Mutual Fund, SBI Mutual Fund, SDFC, and DSP. I'm removing the DSP also. Now, this is the first filter I am applying. So first, before choosing a particular mutual fund scheme, uh, go to mutual fund screener, find a fund. There is a mutual fund screener. And there are different options. First option is the fund house. Fund house means mutual fund organization. Then I'm applying this filter. And there are other mutual fund organizations as well. Now, when you bring it down, you will get it. Then apply. Right? The first thing has been done. Now come to fund category. Now these are the fund categories. Now you want to invest in large and mid cap. ELSS means if you want to save the tax, you can choose the equity link saving scheme. This is the tax saving mutual fund scheme. So suppose you are interested in an ETF. This is the innovative product which I was talking about. So I will give some more time in explaining the ETF, because this is one of the best product of the mutual fund, which only few people explore this uh, because of lack of, they go for the conventional mutual fund schemes, but they don't explore the ETF, because ETF is the substitute of the share market, and it just replicate what share market working of what share market does. So I will take some time for the ETF. So I'm just removing all the options, uh, remove all, and just taking one thing, that is the ELSS. And you can choose the flexi cap. Flexi cap means uh, any sectoral you can choose. So I'm taking one by one. Suppose I'm taking only the ELSS. ELSS means tax saving scheme. Then there is a hybrid fund. Then there is a debt fund. Please remember, you need not to require any professional to select a particular mutual fund scheme which is well suited for you. You just do it yourself. Do your own research. I'm just going through that thing, practical aspect of those things. And after I'm choosing only the ELSS, and then what you can do, apply that filter. So first part I've chosen the fund house. Then I've chosen the fund category. Within the fund category, I've chosen only the ELSS. That is the tax saving. ELSS means equity linked saving schemes. Means that is covered under the section 86. Since old regime is now going to old, yeah, new regime is tax regime is there. So now it is less popular. But assuming that you have opted for the old regime, so ELSS is there because it is covered under the 80C, equity linked savings. So I just for the illustration purposes, I have chosen. Then come to fund rank and ratio. This is very much important. Uh, uh, remove all first. First remove all. Secondly, CRISIL, so fund with CRISIL rank. CRISIL is one of the popular credit rating agency that ranks the mutual fund schemes, because there are thousands mutual fund schemes, and it is very much difficult to identify which mutual fund scheme is best. So thanks to our financial intermediaries, financial rating agencies like CRISIL, one of the well-known rating agency, they rate based on the safety, security, return, and all these risk return profile. They rank and they give stars to our mutual fund scheme. So why not choose the 5 rating and 4 also? 4 also. Then go to second option. Go to second option. Uh, Now, so fund with risk ratio, values better than standard deviation, tenure, alpha, beta. Since mutual fund is a portfolio, mutual fund is a portfolio. Portfolio means set of investment. Because see, here your fund manager invest into the market. Your fund manager invest into the market. And investing into the market means he is creating the portfolio, means set of investment. All the concept of portfolio management will be there. So when you choose the mutual fund schemes, you can choose this. What will be the tenure alpha? For this, you have to go through the particular scheme. Because Jensen alpha, standard deviation, what should the beta? Beta is the sensitivity with the market. If the market goes up, goes down, because you have chosen the equity-based mutual fund scheme. Equity-based mutual fund scheme means your fund manager will invest into the shares of the companies of different economy. So obviously, that mutual fund scheme is actually your money is going into the share market, not directly via the fund manager, via the intermediary. That intermediary is the fund manager. This is the only difference. Ultimately, your money is going to the stock market. So, and beta is the sensitivity of the market with your scheme's return. Means if the beta is high and if market goes down, the NAV. And I told you the mutual fund scheme, units of mutual fund scheme is the price is measured through NAV, net asset value. So if the market goes down, so obviously if beta is high, so the NAV of the scheme will go down. So if you have done analysis, or the thumb rule is just go to the CRISIL, because they have done all the exercise, all the mechanical work, all the scientific investigation themselves to believe on the higher popular credit rating agency like CRISIL and choose 5-star or 4. This is the thumb rule. You need not to go into the technicalities. Once you study these things, you can see the expense ratio also, because ultimately, what is the demerit of investing into the via mutual fund? See, when you invest into the market via the fund manager, you have to bear the cost of fund manager, and this fund manager cost is known as fund management charges. Fund management charges. But thanks to SEBI has made a guideline. Fund manager cannot charge more than 2 to 3% of the entire corpus. And when you actually see the fund management fees, fund management charges, it is less than 1%, 0.2%, 0.3%, 0.6%. Means it is very nominal cost. Fund managers are providing their professional services at a very lower cost. This is the only demerit. When you directly invest into the market, you need not to pay anyone. Because when you invest through the fund manager, obviously you are investing into the concept. You are investing into the story. Because ultimately money invested on behalf of you, money invested by the fund manager to the market. And therefore you have to bear the cost of fund manager, that is the fund management charges. But SEBI is very strict in this way, and being a watchguard of the financial market, especially the stock market and all that, mutual fund market, equity based. So they have made a limit on that. And when you see actual fund manager, it is very nominal. So don't worry about that. Now I'm coming to this. So once you can see the fund management charges also, the expenses, because once all these things will be less, obviously, suppose you have invested 100 rupees and fund management charges is 1%, means 99 rupees will go to the market. And same, if the management expenses is more, less amount will go to the market. So more amount will go to the market, more revenue will be, more wealth will be created. This is the simple logic. Now, the thumb rule is just to choose. So you have chosen the fund house, then the fund category, then the fund rank, and then come to the third parameter. That is the now here there are first see, open-ended mutual fund scheme, closed-ended mutual fund, and exclude FMP, fixed mutual fund. This is very much close. You might never have heard the fixed maturity plans, and you might never invested in the fixed maturity plan. This is the greater. That's why I told you that I will take one by one the conventional investment products and give you a substitute of the most innovative financial product within the same universe, and which will give you a definitely more return than those conventional products. You need not to go anywhere. And this is the best option substitute for the FD, bank FD, that is fixed maturity plans. So I will explain it at a later stage. Just go to the select the open-ended mutual fund only. So fund with AUM means asset under management. I told you the corpus. 100 crore corpus, take it 1,000 or 10,000. This corpus is very much important. Okay, large fund size means your fund manager has a huge corpus. Means your fund because then whatever is fund management charges will be shared by everyone. Means large base of unit holders has contributed, so it will be shared by everyone. So your fund management as an investor per unit charges will substantially go down. So make it as much as possible. Default value is 100 crore. You make it 1,000 crore. And so mutual fund with more than investment in sector uh, like apply sector holding filters. But I have chosen only the ELSS fund, so it is not relevant for us. Just apply it. Just apply it. Right. Then come to the investment parameters. Now, as I told you, you want to go for the fresh purchase or SIP or STP or systematic withdrawal plan, which I have just explained to you. And investment parameters, suppose you are taking for the SIP. So just do it and then apply the filter. Once you have done all these settings, you will get a list of no matching is found. Means you have to little bit explore it. Now, see, these are the 5 or 4 rated tax saving mutual fund schemes. See, the system has directly given you, screened you for the most popular ELSS, that is tax-based mutual fund schemes, which is covered under Section 80C. And in this way, there is a SBI long-term equity fund. Then you have uh, Franklin India ELSS tax saver fund. Then you have HDFC ELSS tax saver fund. When you will get all these data, the asset under management is 18,000. This particular scheme, imagine the situation. This particular scheme has a corpus of 18,714 crore rupees. Imagine the power of the fund manager. That fund manager has 18,714 crore rupees in their hand. Then he can make tsunami in the stock market, because this is the power of the institutional buyers like fund managers or apart from the FIIs. HDFC ALSS tax saver. The fund manager has a corpus of 13,086 crore rupees. Asset under management means the corpus they have, the pool of fund they have for the investment into the market for their diversification. So I hope you have understood the now the most innovative product, as I told you, is the ETF. At least ETF. Actually, this subject require huge. This is a very huge subject, mutual fund scheme. Analyzing the scheme and choosing the particular mutual fund scheme, it is very difficult to cover in 1.5 hour situation.
Yes, sir.
Uh, but I'm trying. I'm just taking you that gold only, which we, the is the gold only, which we were talking about. Yeah, right. Now, I told you the gold, why gold is very much important, because it is 24-hour market. Then second feature is it is the universally accepted metal. And third is it cannot be speculated. Means because stock market can be speculated, your commodity market you see the onion prices goes from rupees 10 to rupees 150, because if 4 and 5 traders just combine themselves and make a pool of 100 crore, yeah, 10 crore, that is sufficient to speculate the commodity market, any share market. Suppose there are 4 person, they pool the fund of suppose 10,000 crore and then can make fluctuation in particular share. So everything can be speculated except the gold. And that is why it is one of the safest. It cannot be produced overnight. Thus, the fourth feature is you cannot produce the gold overnight. It has a processing, and its processing will take time. It's not the factory made material. Okay, you just start producing in batches in factory gold. And the third thing is inflation proof item. But the problem with the gold is when you go with the physical gold, it has the problem issue. The second option to invest into the gold fund, gold fund, gold fund. It is the mutual fund scheme. Mutual fund scheme. Mutual fund scheme. Mutual fund scheme means here the fund manager will invest into the shares of the companies who are related with the gold. Either it is mining of the gold or trading of the gold. But remember it is not going to give the benefit like physical gold. It is not. It cannot be a substitute for the physical gold. The gold fund. Gold fund is a mutual fund scheme. It is not the substitute of a physical gold, because if that company goes down, there is a problem with that company. Your fund will go down. So it has nothing to do with the people have yes, up to some extent, because that if the gold prices will go up, the opportunity will go up. Obviously, that company, if everything is okay, the shares of that company will go up, and accordingly, your sector being a sector, the NAV of a mutual fund, that particular mutual fund scheme will go up. But the strongest substitute for the physical gold is substitute for physical gold is that is gold ETF. This is what we are talking about. Gold ETF. This is the one of the innovative product, and which is the solution for all the problems. If you actually want to invest in gold, investing in physical gold has issue. Investing in gold fund, mutual fund scheme is not a solution, substitute for the physical gold investment. The only solution to the physical gold investment, which overcomes all these issues like cutting from the gold dismiss, safety and security, is the gold ETF. ETF means exchange traded fund. Exchange traded fund. Now understand this, what this is. This is again a very innovative category of the mutual fund scheme. Here the fund manager will buy the gold, physical gold, on your behalf. Suppose you buy 1 unit of physical gold, 1 unit of gold ETF. Gold ETF. It means the fund manager will buy 1 gram physical gold on behalf of you. In other words, you can say buying a gold ETF means you are physically owning the gold. The only demerit is here the fund manager is involved. Therefore, you have to bear the cost of the fund management charges. But since large number of people are investing, so the per unit management price fees goes down substantially. It's nominal charges, so it is not going to affect you. Gold ETF is one of the innovative product, first innovative. So if you want to have gold, which you must have in your portfolio because of these features, you just choose the gold ETF. And the second feature is it is the exchange traded fund, means you can buy and sell the gold like shares. It is the real time trading, and in the market watch, as you list your shares, you can list the gold ETF, and you can buy and sell like shares. Trading can be done, and your fund manager will actually buy the gold on behalf of you. So whatever is the benefit of the physical gold, that will be replicated, that will be transferred to the gold ETF. Suppose after 10 years, you have accumulated, you want physical gold for the marriage of your daughter or for any jewelry and all that. Just sell the gold ETF. Suppose you sell the 100 units of gold ETF. It will depend upon what is the unit size of the gold ETF. But suppose 1 unit is equal to 1 gram. 1 unit is equal to 1 gram. Then 100 units, if you have, means when you sell 100 units, the price you will get will by that money you can actually buy from the market 100 gram of gold. This is the one of the best feature of the gold ETF. Just sell the gold ETF, take the money and go to the physical market and you buy the same amount of gold. Price slightly it could be differ, but almost it will be the same. So without having physical gold, without investing in the gold fund, if you enjoy the benefit of the gold in your portfolio, go for the gold ETF. Now the question is how to choose the gold ETF. Again, go to your this money control site and just type gold ETF, gold ETF, gold ETF. Gold ETF, gold ETF. Now see here, please remember, you have to choose the gold exchange traded fund. Second, you can use the screener also. Yeah, you just choose the ETF, exchange traded fund. Tomorrow, I will tell you one or two most innovative product like Nifty Bees. If you want to invest into the market, so there are just replica. It is not the index fund. It is the just replica of the market. Like, once you see the ETF here, there is a list of exchange traded fund. I'm looking at the SBI ETF Gold. Suppose this is, and here you see SBI ETF Gold. Actually, there are lots of advertisement in this site, so it becomes difficult. You just see this. When you click on this, you will get the form for the purchase of the gold ETF, and when you go through it, you will find it. Now here it is given your fund manager asset allocation pattern of this scheme means when you will purchase the gold ETF, 100%, 90% minimum and 100% maximum. Your fund manager is bound to invest in gold and gold bullion. Means gold, physical gold. And only 10%, 0 to 10%, he can invest in debt and money market instrument just for the liquidity purposes. This is 10%. He is taking the margin for the liquidity purchase because someone if make the claim for the redemption, he can make the payment also. Otherwise, here see the allocation. Fund manager is not investing the share of any of the company. related to gold mining or gold trading. Here in gold ETF, the fund manager is allocating the entire money of the investor, that is the unit holder, in the gold, physical gold and gold bullion, means physical gold, 100%. This is the indicative analysis. That is why I said uh, buying the gold ETF means you are physically buying the physical uh, buying of the gold. And whenever you want to have a jewelry, you just sell the gold ETF, and with the same amount, you approach to the physical market and buy the same amount of physical. Tomorrow I will give you a brief on the how to buy the second innovative product, that is the Nifty. Nifty's how to you directly invest into the Nifty, because index fund is not the solution, because your fund manager will invest in the companies listed under the Nifty or the Sensex. But when in the Nifty, suppose the company changes, so in the index fund, it is not going to make that changes. The solution is the Nifty Bs. There are lots of ETF, index-based ETF, that is Nifty Bs, and there are different strategies using that. Suppose you can do the stock SIP also, ETF SIP. So suppose you can invest per day. Suppose gold ETF you are choosing. So take it weekly. Per week, you buy 1 unit. So in the month, you will buy 4 units. So this will be affordable for you. And in the long run, you will accumulate as much unit you can. And there is no risk of the market at all. Same with the Nifty. If you are positive about the Indian economy, so you go for the Nifty Bs launched by different companies. Might be here, it is there. See when you go to the when you see this, there are market-based exchange, because and you take any for this you require demat account, and you need to have your demat account with your broker, because only then you can purchase this, because this is actual there is a Nippon ETF, and this is Nifty Bs, one of the best product which actually replicate the Nifty Bs, where it is uh, Nifty ETF and Nippon. So tomorrow I will sell you the broker side, and just to do the stock SIP. The people buy and sell in the stock market like a limit order, market order is just one time. There are now the broker has become very much innovative. You can place the order value till trigger, means when the price will reach in 1 month, 2 months, 1 week, then your trade will executed. And secondly, you can invest directly into the market. You can purchase the market also, and that is converted into the shares. So I will show you the broker side also, so that you can understand. Hope this is a technical session, so might be you got bored, but there are so innovative product. So one of the substitute I told you, if you are going for the gold, just go for the gold ETF, gold ETF, gold ETF, and if you are just go for the gold ETF, and there are other products like if you want to invest, if you are positive about the market, so Nifty Bs is the index weight. It is again exchange traded fund. So I mean to say exchange traded fund is the good substitute for the whole market you can buy in unit term. And secondly, for the FD bank, if the substitute is fixed maturity plan, using the screener of the mutual fund, you can choose the fixed maturity plan, and this is the one of the best product that substitute the bank FD and will give you the more return compared to the bank FD on deposit of corporate bonds like that. So if there are conventional product, by just looking at the market, the lots of products have came into the market. using that products, you can go for the some innovative products also. Thank you very much. I think time is more than that.
Yes, sir. Thank you so much, sir, for today's session. And really, it was, sir, wonderful insights to know about some innovative products which you have just discussed, and many insights from the mutual fund industry as well, sir. Like how to look at the stock screener, how to find out the good funds and all. Thank you so much, sir, for your deep delivery of the knowledge, sir. Thank you so much, sir.
Right.
If there is any doubt from the participants, they can ask. I think, sir, there